Welcome back to our class. This is teacher Onin Guzman, and our topic for today is financial planning process for business finance. The outline of our discussion will be financial planning. Number two is business vision and mission. Number three is financial planning process, and number four is the podcast. Let us recall the meaning of financial planning. So it is one of the most important concepts in the various area of finance. It is the offshoot of interrelated planning activities, as well as must be firmly anchored on the thrust of the business. If we will look to the business planning summary, so we have here step number one, we have forecast settings on sales cost, expenses, and capital expenditures. Then we have preparation of the projected financial statement. And number three is analysis and evaluation of projected financial statements. And number four, review and evaluation of the projected financial plan. All of these steps are actually anchored on vision, mission, goals, and objectives of the company. Remember that vision it conveys the ultimate goal of the organization. So for example, SM Supermalls aims to become Asia's most popular mall chain through constant innovation and partnership with the world's best retailers. Another example is Tim Cook's vision for Apple. Stress that we believe that we are on the face of the earth to make great products and that's not changing. On the other hand, if we say mission, it sets the current business activities and outlines what the business is for. Example, so Apple's more than 100,000 employees are dedicated to making the best product on earth and to leaving the world better than we found it. So let's move on to the third part, which is the financial planning process. So number one in the business makes explicit assumptions on the future levels of the following. So we have sales, costs, operating expenses, capital expenditures, as well as borrowings and interest. Next on financial planning processes, so we have projected financial statements are prepared. Number three is the projected financial statements are commonly analyzed and interpreted using the financial mix ratios. So as we discussed from the previous chapter, number four is the general financial plan is evaluated and reviewed by the top level management for improvement, taking into account present trends and developments in the external environment. As we move on to the forecast, so we have the following items. So number one is the sale projection is estimated. Number two, the production schedule together with the estimated cost of production is computed and prepared. Number three, the marketing and administrative expenses is estimated. Number four, additional funds are requirements to determine. And number five is the projected financial statements are prepared. For the forecast techniques, we will limit our discussion to three techniques. So the first of which is the simple moving averages. So it is an arithmetic moving average calculated by adding recent prices and then dividing that figure by the number of time periods in the calculation average. The second one is the weighted moving average. It assigns a heavier weighting to current data points since they are more relevant than data points in the distant past. And finally, we have arithmetic geometric curve. So the value of R, which is the average rate of increase or decrease in demand of a particular product. So let's have example on the simple moving averages. So calculate the simple moving average of a security with the following closing prices over 15 days. So we have week 1, we have 5 days. We have 20, 22, 24, 25, 23. For week 2, we have another 5 days. We have 26, 28, 26, 29, 27. And week 3, we have for 5 days. We have namely 28, 30, 27, 29, and 28. Again, to solve for the simple moving averages, we have a sub 1, a sub 2, a sub 3 until a sub n divided by n, wherein a sub n is the price of an asset at period and n is the total number of periods. So we have actually 15 periods, so that is n is equal to 15, and we will add starting from 20, 22, 24 until 27, 29, and 28. So therefore, the simple moving averages is equal to 26. Let's move on to weighted moving averages. So say for instance, we have the following data. So starting from June 20 until June 26. As you can see, we have actually 5 dates. So we will use the formula of moving weighted moving averages. So this is equal to price 1 times n plus price 2 times n minus 1 until price n divided by n times n plus 1 all over 2, wherein n is equal to time period. So since we have 5 time period from 20 to until 26, so if we will simplify the denominator, so this is actually 5 times 5 plus 1 all over 2. So the denominator is equal to 15. So take note that we will give more weight to the most recent date, which is actually June 26. So out of 5, so that is actually 5. So 5 over 15, followed by June 25 4 until 1 on June 20. Okay, so applying the formula, we will have now, this is 90.90 times the weighting, or that is the weight. So we will multiply 90.90 times 5 over 15, 90.36 times 4 over 15, 90.26 times 3 over 15, then we have 90.83 times 2 over 15, and finally 90.91 times 1 over 15 divided by the total 15. So therefore, we can say that the weighted moving average is equal to 90.62. Let us now move to arithmetic geometric curve. Say for instance, we have Chinese trading sales starting from 2014 until 2018. So notice that there is somehow increase in the sales. Now, in order to determine the arithmetic geometric curve, so let's start from 2014. So first, let's determine the percent of increase. So since we started from 2014, so we don't have yet the percent of increase. However, on 2014, so to compute the percent of increase, so that is the present sales minus the previous sales divided by the previous sales. So what we have is 77.46%. Similarly, in 2016, so we will subtract the present sales of 28,750 minus 24,500 divided by 24,500. So we come up with 17.35%. Similarly, we will do the same on 2017 and 2018. So we have 32,900 minus 28,750 divided by 28,750. And this is the result. And we will do the same again, present sales minus the previous sales divided by the previous sales. So we have 10.49. Now, so what we're going to do is add all of these numbers and divide by 4. So the sum from 7.46 until 10.49% is equal to 49.73% divided by 4, so we have 12.43%. So we call this one as our average percent of increase. under arithmetic geometry. Now, so we can use this one in order to, okay, determine your projected sales. So based on the average change percentage of 12.43 as we computed here, the projected sales of Johnny Trading for 2019 is actually 36,000 from the previous sales here 36,350 times. We add 100% to 12.43%. So that is why the projected sales in 2019 is 40,868. Now that we know the projected sales, let's move on to the production schedule. Under the production schedule, we have the following: the number of units and cost of raw materials, then we have direct labor costs, then we have manufacturing overhead costs, and finally, desired inventory level. Let us use the data from Janet Trading for 2019. So again, our projected sales is equal to 40,868. In order to determine our cost of materials, so say for instance, we have three types of raw materials required to produce one unit of finished product. So what we're going to do is to list it down. So say for instance, we have material and the number of units. So we have material AA, we have 2 units. Material BB, 3 units. Material CC is equal to 3 units. So again, we need to produce 40,868 as projected number of sales in 2019 for Johnny Trading. So what we have, let's compute for the total cost of materials. So in order to determine the total cost of materials, take note that the projected sales is equal to 40,868. So we have the following materials. We have AA, BB, CC, and the total number of units per piece. So we have here 2, 3, and 5 respectively. So again, to determine the total number of units, so what we're going to do is 40,868 times 2, we come up with 81,736. As well as 40,868 times 3, we have 122,604. Then we have finally 5 times 40,868. So we have 204,340. Now, say for instance the cost per unit. So this is example only. So the cost per unit is 150. So multiply 81,736 times 150. So we come up with 122,604. As well as 122,604 times 2. So we have 245,208. Then we have 204,340 times 250. So we have 510,850. So if we will add all the total cost of materials, we will come up with 878,662 pesos. Since we know already the total cost of materials, let's move on to the labor cost. So if you say labor cost, it refers to the amount of paid to workers directly involved in making the product. So example, so 3 hours are required to finish one product. Since from our projected sales, we have 40,868 units. Now to determine the total cost, so we have number of units of 40,868. So take note the number of hours to finish one unit is equal to 3. So simply multiply this one, 40,868 times 3. So the total number of direct labor is equal to 122,604 hours. However, say for instance the labor rate per hour is 8 pesos. So that is why if we will multiply the total number of hours times the okay, labor rate per hour. So 122,604 times 8. So this is equal to 980,832. So this is your projected labor cost. On the other hand, if we say manufacturing overhead costs refers to costs incurred in producing a product that cannot be classified as direct materials and direct labor costs. This cost includes, among others, the salary paid to the supervisor, light and water, depreciation of machinery, fuel and gas related to production, and indirect materials. Now that we know already our labor costs as well as the cost of materials, let's move on now to additional fund needed by the business. Whenever we say that one, so dividends are the amounts of income returned to the owners. Also, dividends payout ratio is the ratio of dividends to the earnings of the business. And finally, retention ratio is the ratio of earnings invested. Other terms that we will use here are actually AFN, or that is additional fund needed, projected increase in sales minus spontaneous increase in current liabilities minus increase in return earnings, while the projected increase assets is equal to change in sales times the CA, the current asset, divided by the sales as in present. Next, also another formula that we will use, we have spontaneous in current liabilities, that is the CL, is equal to change in sales times the current liabilities divided by the sales in present. And also, the increase in return earnings is equal to earnings after tax minus dividend payment. So now that we know, let us consider example for additional plan needed by the business. So say for instance, the Guzman Manufacturing Company presents the following information related to 2020 results and operations. So we have sales of 7 million, the current assets is 4,200,000, non-current assets is 2.8 million, current liabilities is 980,000, non-current liabilities is 770,000, while ordinary shares is 4.2 million, and the retained earnings is 1,050,000. In addition to that one, the cost of sales is 60% of sales, and the operation expenses is 25% of sales. The interest expense amount to 245,000. The applicable tax rate is 30%. The company expects to maintain this relationship in 2021 operations and plan to pay 60% of the income as dividends to shareholders. The business expects 10% increase in sales in 2021. Non-current assets in 2021 are not expected to increase, including non-current liabilities as well as spontaneous to the increased sales. So let's solve or determine whether additional funds are needed because of the expected increase in sales. And number two is prepare the projected statement of financial position. Now, in order to solve the problem whether we need additional fund needed by the business, so we'll have our step number one. So we have to compute the projected increase in sales. Recall that projected increased assets or in sales is equal to change in sales times the current assets divided by sales as present. So we have here our 10%. So we want the 10%. So the business expect 10% increase in sales, while our current assets is equal to 4,200,000. And our sales as of the moment is 7 million. So if we will compute this one, so that is actually 700,000 times 60%. So the projected increase in sales is equal to 420,000 pesos. So let's move on to step number two. So that is compute the spontaneous increase in current liabilities. Let's recall that the formula is equal to change in sales times current liabilities divided by the sales. So our current liabilities is equal to 980,000 and our current sales is 7 million. So we have 10% increase. So if we will solve this one, so we have 700,000 times 14%, or this is equal to 98,000 pesos. So the next step is we will determine the expected earnings after tax. So again, so we will prepare our sales. So we have that is 7 million from the previous, since we will have 10% increase. So we have 7.7 million. Less cost of sales, so that is the 60% of your sales. So we have 4.62 million. And the gross profit is, to simply subtract this together, we have 3,080,000. Then less operating expenses, so that is sales times 25% based from the problem. So we have 1.925 million. Then income before taxes, so we have now, if we will subtract this together, the gross profit and the operating expenses will come up with 1,155,000. Then we will subtract the interest expense of 245,000. So we have the income before taxes is 910,000. So take note that our income tax is 30%. So that is why 910 times 30%. So this is equal to 273,000. So therefore, the net income after tax is 637,000 pesos. So let's recall that the earnings will be divided into two parts, so either the dividends or retained. So take note that our earnings a while ago, what we computed is 637,000, but then according to the problem that we will give 60% of the income as dividends to shareholders. So that is why if we will compute 60% of 637,000, so we come up with 382,200. Now, if we want to find out the retained earnings, so simply subtract 637,000 by 382,200. So you have now retained earnings of 254,800. So the question is, do you really need additional fund for your business? So let's recall that additional funds needed is equal to projected increase in sales minus spontaneous increase in current liabilities minus increase in retained earnings. So we have 420,000 as the projected increase in sales minus 98,000 as current liabilities, or increase in current liabilities, minus the increase in retained earnings. So you need 67,200. So the question is, where will you get this? So the answer may be, it may be from your own pocket, or you will do the borrowings. So let's move on to the second part of the problem. So that is, we will prepare the projected statement of financial position. So that is why now we have here the current assets, or the assets, liabilities, shareholders equity, and of course additional fund needed in case. So take note that the current assets of 4,200,000 times 1.1, so we'll come up with 4.62 million. The non-current assets is the same as 2,800,000. So your total assets is 7.42 million. On the other hand, your current liabilities, as projected as 10%, will increase by 10%. So you have 980,000 times 1.1. So you have 1,078,000. While your non-current liabilities is 770,000 pesos as a total of 1.848 million. While your equities are the following. Your ordinary is 4.2 million, and the return earnings is 1,050,000 plus 254,800. So the total is 1,304,800. So the total is 5,504,800. So if we will add together, all in all, so your return earnings as well as this, okay, guys, you have 7,352,800. So in order to balance this, okay, with your total current assets of 7,420,000, so you need additional fund needed of 67,000 so that your total assets and liabilities will be equal to 7,420,000. So that ends our topic. Again, this is Teacher Onen Guzman. Do not forget to subscribe to my channel so that you will be notified about my new videos. Thank you.